and give you my thoughts, and I'll be interested in yours on kind of where they fit overall in our recovery. So next slide, we'll just go right in. You can do the next one. 2 bits of background before we get into the different models. The first is to note that, and I maybe don't need to know this to this audience, but insurance can be offered at all scales. And so we're often talking about sort of household or individual level policies, but they're actually much smaller policies. I'm going to be talking a little bit about microinsurance today, which are smaller coverage policies, but we're also seeing the emergence of things like short duration policies, like policies for gig workers that turn on and off literally by the hour, all the way up to big scale policies where countries are making use of insurance. So for things in like the Caribbean catastrophe pool. So we're going to talk today about not as much the standard model, although a little bit, but micro policies and meso policies. Next slide. And a lot of the models are going to draw on parametric concepts that I'm going to talk about today. So I'm sure some of you are quite familiar with this, but just to make sure we're all on the same page here. Your sort of standard homeowners, standard NFIP policy, standard auto policy are what is often referred to as indemnity coverage. And that means, subject to the terms and conditions of that policy, you get a payout that's related to the amount of damage you sustain. And so the way that works is that a loss adjuster, a person, has to show up at your house and assess the damage. That does a couple things. That means in a post-disaster context, it can delay payment because we know after really big disaster events, there's often not enough adjusters. It creates some subjectivity and contention between the policyholder and the insurance company. But you get, subject again to the terms of your policy, the damage that you sustain. Parametric is really different. Under this model, the amount of money you get is a predetermined amount that gets paid out based on an observable measure of the hazard itself. So flooding, it's a little harder. We're going to have to come back to that. But think in your head about, say, hurricane winds. If wind speeds within so many miles of your house exceed a threshold, you automatically get that preset amount of money deposited in your bank account. So a couple of things to note here. One, it's really fast because the payout is just an observation of an independent metric that you know as the disaster is unfolding or soon thereafter. So it can get dollars faster. The dollars are also very flexible. You can use them for any type of economic loss. They're not just direct compensation for the specific property damage. And there's lower transaction costs for the company to administer this type of policy because they don't have to send a loss adjuster to come talk to you and assess your damage. It is also, as you can see, very much not a substitute for when you need the full indemnity covered, and we're going to come back to that. What it is a new tool in the toolbox to cover other types of losses. We probably don't want to get down in the weeds on this today, but you'll often hear the term parametric insurance when what they're actually talking about, and this is particularly true globally, is not insurance at all, is actually a financial product. For it to be insurance, of course, it has to meet our insurance laws and regulations, so there has to be a proof of loss, right, and an insurable interest. So you still, so you can't profit off it, right, because that would be speculative gambling instead of. So anyway, we can get into how that's actually done in some of the parametric policies that are offered, but to be clear. Okay, next slide. So the key to parametrics is defining that trigger. When do the dollars get paid? So it needs to be independent, objective, easy and fast to verify, and it needs to be tightly correlated with the economic loss that we're trying to fill. Because if the parametric product pays out when you don't really need it to, you're paying too much in premium, because the more it pays out, the higher your premium. So you don't want to be paying for times you don't need it. But if you need it and it doesn't pay off, then it's been useless for you. So the art of these types of things is really making sure that that trigger is very tightly correlated to the types of hazard events for when you need it. Examples that have been used in this space are things like NOAA wind speed, right? Like government agencies that kind of have independent measurements. For flooding, we've seen looks at things like precipitation measurements. The New York City Transit Authority has a parametric one that's based on surge gauges. And then there's been some interest in using sort of smart sensor technology. So Flood Flash is a parametric flood company that started in the UK and is coming to the US now, largely for commercial, not residential, but they install a strip on the building that measures flood heights in real time. And as it hits certain levels, you get different amounts of payoff. Okay, next slide.
Excuse me, I'm sorry.
Yes.
Those three categories, are they the proof of loss?
No. So those are the measure of the hazard. And then additionally, so when that hazard level is hit, so say you hit the NOAA wind speed,
Right.
you would also have to show that there was some type of economic loss. That's been done in different ways.
Okay.
So for example, there's a household level parametric product for earthquake that's now offered in all the states on the West Coast.
Right.
And they have a very simple thing where the company texts you and says, ground shaking has exceeded this threshold, your policy's triggered. Did you face any economic loss? And you have to say yes. Now, those kind of simple things are important because the whole idea is here for it to be fast and to not have to involve the adjustment. But, which is fine for small payouts like microinsurance, which we're going to talk about here. And for example, in Puerto Rico, they've completely waived proof of loss because if we're talking about $10,000 in a major catastrophe, there's no doubt that people have sustained that much economic loss.
So those three bullets are really just the causation piece. And then you still have to prove that you've actually had a damage. Okay.
Correct. Yeah. Okay. So we're going to talk about these three today. So I'll kind of provide high-level overviews. I should have said at the beginning, please interrupt anytime. Happy to talk, take questions, go deeper wherever is helpful. Okay. Any other questions before we go into the models? Okay. We'll start with microinsurance. So if you want to jump ahead to, so microinsurance is a tool that's been used globally for a long time for a range of coverages, agriculture, livestock, life, health. They are policies that have low coverage limits and so lower premiums, and they're explicitly designed for lower income populations. So they sort of emerged in developing countries where there were not well-established insurance markets and where some of the populations would also be difficult to reach or very expensive to reach for traditional loss adjustment. But this type of parametric approach allowed them to provide financial protection to these difficult to reach populations and populations that might need very small amounts of money. And so the economics doesn't work. If you have to pay more to the loss adjuster than you actually need to give to the policyholder. Next slide. So now we've been thinking about whether this has a role in helping certain types of populations within the US. And so the first thing to note, of course, that this is not a replacement for homeowners coverage. It would not satisfy mandatory purchase for flood insurance. What this is a way to fill other holes we have in our safety net, which are things like, next slide. So some of the uses that have been explored in the US context so far, one is immediate needs. So we see in the immediate aftermath of a big disaster, like a big flood, households face costs on day one. Evacuation expenditures, temporary living, cleaning up debris, mold remediation, these types of costs start accumulating right away. And we know that lots of the dollars we have to help people take weeks or sometimes months to get to them, whether that's your standard insurance policy or whether that's FEMA individual assistance or whether that's an SBA loan. There's this gap between when the disaster happens and when you actually start getting financial help. And for more affluent families, we've seen in survey research, that's not a problem. They have liquid savings, they use their credit card and pay it off later, and it doesn't present any sort of long-term challenges for the household. But what we also saw was that for lower income households, not having the dollars right away is a huge problem. And they have to do things like stop paying their bills or their rent or their healthcare expenditures in order to cover the immediate disaster costs. And so for that population, having dollars quickly is actually really important. And parametric microinsurance is a way to kind of fill that unmet need we have right now. We've also seen it used in places around the US like Puerto Rico, South Carolina, the Gulf Coast, where there's a lot of heirs property or people who don't have clear title to the land that can present a barrier to getting standard insurance. And these types of policies can be tied to the person, and so they're easier to obtain in that situation. It also allows you to cover losses that are non-property damage. And that can be really helpful for some populations like renters, whose biggest cost after a disaster tends not to be property. They don't own the home they're in. So like the structural damage would be paid by the owner, not them. But what we see as the biggest cost for renters after a disaster is that rental prices tend to go up because demand goes down because a lot of property is damaged. So, supply goes down, demand goes up, and so rental prices go up. So these types of dollars can be used for that type of non-property loss. The other big place it's been used is for households who cannot afford anything else. And would it be better if they could afford a full indemnity policy? Sure. But if it's the choice between having no insurance at all and getting $10,000 to jumpstart their recovery, this is preferable to nothing. Okay. I guess I'll finish microinsurance and if there's any questions on it. The only place in the US so far that has actually launched a full microinsurance market. There's a few microinsurance-like products, like this earthquake one I mentioned. There's a hurricane one in Florida. The only place that's launched sort of like a full market is Puerto Rico. They've put in place enabling regulations, and there was a couple reasons for this. One is to put some bounds on the premium to keep it affordable, but also, and some guidelines on communication about the product, because this is very different from typical insurance. So you don't want consumers to think they're getting an indemnity policy when they're not. But also because, and you can click to the next slide, microinsurance has tended to be provided in very different ways than your standard indemnity policies. For a homeowner's policy or an NFIP policy, you go to an insurance agent and you talk to that agent and you get a quote and you get a policy. Globally, microinsurance has been, you can do it that way. You can't do it in Pennsylvania, we don't have a market, but in places where you do, you can do that in Puerto Rico, you could just get it. But there's also other approaches. So the next one, we've seen a lot of use of microinsurance on mobile platforms. So like literally you buy your insurance in an app, and you get your payout on a mobile money platform. The nice thing about those is that they also, and there's not really any of them in the US, I'm talking globally now, is that they also often link to things like preparedness information and risk reduction information and recovery information. So they become sort of like a more comprehensive disaster interaction with the person, or also more commonly is embedding it with something else. So lenders tie a microinsurance product to their loan. We've seen ag examples where when you buy certain agricultural inputs, it comes with a microinsurance product tied to it. It's tied to a rental agreement. It's tied to a government program. So you're sort of automatically enrolled in getting this. In Puerto Rico, we've seen some sort of stranger embeddedness. There was a car dealership that was really giving you microinsurance policies if you bought a car during hurricane season. So I don't really understand that one, but so lots of different ways to kind of get this product out to consumers. It's not our traditional insurance agent. Okay, last slide on this, like some implementation considerations. Getting it launched would be a difficult thing in places where there's not already a market. We don't need to talk about that more right now, but that's sort of for a different conversation. But a kind of question is like, is this meeting needs? And so is the population that you're trying to help, can they afford the premium payment? Can they afford some or all of it? We've seen this microinsurance concept want to be used for communities that can't afford anything else, but often those are the very households that can't really afford anything. They don't have any disposable income to put towards insurance. And so we see a lot of microinsurance is supported through the public sector or philanthropically buying the policies on behalf of households at need. And then we can come back to this. I've already mentioned this, but getting a good trigger for flooding can be really difficult. We'll just pause on that one. Okay. Any questions on microinsurance, or should I move now into this one?
Is group going to include New York City and the nonprofit program that they have?
Yeah.
Okay, then we can, I'll hold my questions.
Okay.
Any other questions right now? No, okay.
Okay. Group insurance models are essentially, they come in various flavors. And the entire idea is that you're putting another entity between the policyholder and the insurance company. And there's a few reasons you might want to do that. The first is to get widespread coverage to close disaster insurance gaps. We know it is really hard to increase purchase of disaster insurance, of flood insurance, if you try to go house by house by house and convince people. There's a lot of reasons for that get into behavioral economics and risk communication and awareness and our over optimism and a whole bunch of things we could unpack. But it's hard to close disaster insurance gaps by trying to convince each household. This is a way to just insure a whole bunch of people at once. The second reason is that in sort of these, especially in these more innovative spaces, we've seen kind of a disconnect where there's a lot of leading reinsurance companies, brokers globally who want to be helping better manage climate risk, better improve equity in recovery, but they're often very disconnected from the specific needs on the ground in a specific community. And so often the products they're offering are not actually very well suited to what the needs are on the ground. On the other side, we've done a lot of work with local governments and community organizations who don't understand insurance markets at all. And so they don't know what's possible or how to engage the market, or also how to differentiate when they're being pitched something. Does this really meet my needs or not? And so having an intermediary in there who can do the kind of two-way translation can be helpful. And then the third thing is there's been hope that this would be a way to better link insurance with risk reduction. Because if you're purchasing insurance at a group scale, you might be able to get more premium reduction for community level investments in risk reduction, and thus open up this like tantalizing possibility that everyone would love, where the sort of insurance premium reductions for risk reduction can be brought forward in time as a financing tool to finance more risk reduction. Okay, so that's why people get excited about it. Next slide. There's two different models. There's a facilitator model and a purchaser model. So I'll go through each of these. So the next slide, the facilitator model is essentially, think of an employer providing health insurance, except make it not an employer, but anything else you could think of, a local government, a community organization, and it's not health insurance, it's disaster cover. So essentially it's an organization who works with an insurer to come up with policy pricing and terms, and then makes that available to a group of people, the way an employer would negotiate with a health insurer and make a menu of plans available to employees. And then the contracts are between the insurer and the insured. The intermediary is not actually involved in those contracts or those claims payouts. They might subsidize the premium, right? In the same way that an employer might pay part of the cost of a health insurance premium for someone. So that's the first model. The next one, there's two flavors of the purchaser model. The first one is that an organization buys one big policy with a bunch of named beneficiaries, which is essentially, you can just think of as like buying insurance on behalf of a bunch of people. For this to work, you have to know who you're insuring, and you'll see how that's different from the next one in a second. So it's like Carolyn Kuski is listed as getting this much money under this policy. I don't know of any examples of this in the US. We know a few globally. One's being used in Mexico, where an organization has purchased this big policy to provide microinsurance payments to members of this agricultural community if there's a big hurricane. And so they have these individual policies, and the members of the community are listed. Okay, the one that has been used, this gets to the New York City example, is where the intermediary actually purchases the insurance themselves. And then they use that to fund an assistance program to the people they want to help. So this is a pilot that we put together with the Mayor's Office of Climate and Environmental Justice in New York City and a large affordable housing NGO, the Center for New York City Neighborhoods. And essentially, we designed a flood parametric product for inland flooding. There was a lot of reasons we focused on inland flooding. In the coastal communities of New York City, they have pretty good take-up of NFIP coverage. Intense rain is getting a lot worse in this whole mid-Atlantic region, right, and causing problems. So that was the focus here. And when one of these rainfall flood events occurs and the policy triggers, the center gets the money, and then they turn that around in emergency grants to households. And so essentially, this is like using insurance to finance an assistance program. And they've stood up this whole assistance program.
But Carolyn,
Yes.
It's not actually an insurance product, right?
This one is not an insurance
It's a
product.
financial derivative.
This is a derivative offered by Swiss Re and brokered by Guy Carpenter.
Yeah, because how does the insured in this case, or I'll use the term insured, which would be the city, demonstrate a loss? It doesn't happen. Right?
So demonstrating the loss, we actually satisfied that one. And essentially, the Center for New York City Neighborhoods created a separate bank account to fund this recovery program. And a loss is them paying the households.
Whenever it gets paid out.
Yes, and there's actually a clause in the contract that if they don't have enough demand for the grants, like they don't have enough people to issue grants for,
Right.
the money goes back to Swiss Re. There's a clawback provision so that they can't profit off it if they're not giving the money to the households. So that one got solved. The problem that we ran into, and this was funded by a grant that had a 12-month clock on it. We had to get up and operational in a year, so we didn't have time to work out this one. The concern for this one is like a couple. Maybe you guys have better ways. This is my layman's explanation of some regulatory stuff that I don't understand very well. One was like there wasn't a bucket for it. Like, what is this? It's not property insurance because we want to use it for other things. It's not covering like potential liabilities. And it was like really unclear how to classify it. And then it was also unclear. It looked an awful lot like the center buying insurance on behalf of other people, which you can't do for very good reason, right? We don't want to like buy insurance on our neighbor's house and then have an incentive to burn it down. So
you have to have an insurable interest is what we would call it.
And so like, do they have how do we show that they have an insurable interest in helping these communities? That was not solved.
But it did get off the ground though.
Yeah, as a derivative, because that didn't matter since it was a derivative. That didn't matter.
And it continued to operate as a derivative, or it still does?
Yes, they just started year 2.
Okay. Are you continuing on that space, or is now a good time to talk about how that works more?
Now is a good time. I was going to switch to my last model after this, which is very different. It's about encouraging resilience.
Okay.
So now would be the time to talk.
So in this instance, the nonprofit, we have maybe 100 families or something. And actually, one of our last meetings, we went out to a local community actually in Yardley. And I'm thinking about a particular neighborhood in Yardley that had been impacted in flooding. Like if they, through like a homeowners association or something, formed this nonprofit that would then set up a derivative where the members of the homeowners association contribute. So I guess they would still pay not a premium, but whatever we want to call it, the contribution to the program, that if they get 2 inches of rain in 15 hours, everybody gets paid out something, but it comes through the association again, right?
Yes, correct.
Like, how do you?
So there'd be a couple ways to do that. Like one is it could go to the association and they pay out, or you could structure it where like each of the members actually has an individual contract so that the intermediary isn't playing that role. In this case, the center is very well positioned and has many times distributed assistance to the households it helps. You can imagine other intermediaries, like maybe a homeowners association that doesn't want to take in $1 million and turn it around. And so you could structure it this other way. Maybe it might be helpful to share just a minute. We've been in conversations with folks in the city of Philadelphia about whether any of these models might help in Eastwood. And I should say these are early preliminary conversations. So, you know, this is just early days, to be clear about that. But what we've been talking about is that some type of parametric micro flood product could be helpful for populations like that, where there's two things. One is the NFIP is not really well designed for this community for a couple reasons. One is I think there's a few reasons. One is affordability, why you're all here. Also, in Eastwick, a lot of the homes are sort of set down like this off the road, and what is maybe the basement or the first floor is what floods, and what a lot of damage they sustain is contents to that floor, which are largely excluded from NFIP policies. So some of the biggest losses they're facing aren't even covered in the NFIP. And then also, in order to get replacement cost coverage through the NFIP, you have to insure 80% or more to value. But this is a community that's never going to see, okay, I shouldn't say never, that is probably rarely going to see that type of loss. Like, they're not worried about their entire house being knocked over by storm surge. They get a couple of inches in the basement and they've lost a bunch of, they have to like re-tile, and they've lost some appliances and some content. And so it's a very different type of loss. And so this population would really benefit from getting $25K day 5 after the flood, no questions asked, use for whatever you need. And so this type of model would fit really well there. Another place where we think that this could fit really well, also in our conversations about Eastwick in particular, are that there's discussions underway to put in place more structural protection measures, a levy, maybe some buyouts. But what do you do in between when there's still high risk between now and like that, and how, you know, how long it takes those types of investments to be made? So could the city step in and provide some type of insurance coverage like you were kind of describing to protect people in the interim when the protection is coming online? So that gives some other ideas.
When it's not insurance, are we all guaranteed or a payment. I'm thinking the situation, Dave and I are neighbors. We hit the 2-inch in 15-hour threshold. So we both get to draw the $10,000, right? Regardless of, I had damage, he didn't, but it still triggers for both of us, I think.
It's pro rata. So that the question, my question is an allocation question. Is everyone get the same amount? Or is there, because you can have 2 inches, and in some of those neighborhoods that we saw, that can affect one house very differently than the next house. And you can have issues where neighbors are like, well, wait, he got 10 grand and I need really 15 and he only needed 5, and that's not equitable.
Yeah.
How does that work?
Yes. So I can tell you what's happening in New York City and then what's possible. In New York City, part of the reason that people aren't predefined ahead of time is so that the Center for New York City Neighborhoods can make those judgments about need. And so they just get a payout because this neighborhood flooded. And then they have on the ground advisors who are doing that, like, you have more damage, you need help. It flooded your neighborhood, but you're fine. We're not going to give you anything. And so the center is making those decisions. And they've left it open that they could scale the amount of payment they give people based on need. Now, they're in internal conversations about whether, maybe politically is not the right word, but whether they want to do that for fairness reasons. Like, is it more, like, will people be able to see, oh, you actually had a 10K loss and I only had a 5K loss? Or are they just going to see the money that goes out the door and want everyone to get the same amount? That's like, that has nothing to do with the actual insurance payment from Swiss Re. That's entirely the center's decision about how they want to structure their assistance. If instead, though, like we've been exploring potentially in some Philadelphia neighborhoods where there's not an equivalent NGO that could play that role, what you'd want is the households to have individual contracts, because there's not someone who's going to come in and distribute that. And then you'd get that exact thing you're talking about. If you both enrolled in it, you both get exactly the same amount, no matter whether your damages differed or not.
I think who the aggregator is matters a lot.
Yes.
If it's a township, I can see that getting squirrely pretty quickly. If it is a separate organization that's set up that has maybe a little bit more insulation or distance, that might be more doable. But I think having the flexibility to really assess what the damage is, as opposed to everyone, unless everyone understands up front, this is what you're getting and that's what they bargained for, okay. But it's not necessarily meeting.
I have a point on that too. You mentioned that there is another group flood insurance policy, and that's like individual assistance. When that gets opened up, they'll pay $2,400 from the IHP program, and their coverage is for 3 years, and it's up to $85,000. So my question has always been with FEMA IA, how do you know what their needs are in that community? If you get hit in Southeast PA, your costs are going to be a lot higher than, say, another part of Pennsylvania. So I don't know if that's something that we could also maybe take up to FEMA and say, look, that's probably not enough, or there's got to be some kind of stratification for that insurance.
Is a co-proxy you can come to the table.
Oh, sorry.
Might be more helpful. Just come on over. Did you have an answer for that?
Well, I have some comments, which is that I think that some of what these programs are trying to do is fill in IA holes, like the time where you don't get IA declared, but it's still a localized disaster. And so people still need help, but it really hasn't risen to the level of getting a presidential declaration. Like, that's one thing. Or when IA is insufficient and there's still extra need, how do you pair them together? But I think that's a really important conversation, is like, where does this sit via these existing programs that we have? And do we need additional programs, or can we do things to reform the ones we have instead? I think that's really important.
Both.
Yeah, both. And that also made me think another concept that I've heard some communities starting to talk about, more specifically to affordability of NFIP, is could you do something like this, where you guarantee the first $10,000 of flood loss and then let people buy high deductible NFIPs on top of it? And that makes the NFIP policy cheaper because you have such a high deductible, and kind of has the local government pick up the kind of first layer. I think some of the challenges that we've seen, that I'm sure you've all seen, this is abstracts away from all the innovation. This is just a general point. People want coverage for high frequency risks that are not cost effective to insure. And I find it very difficult to explain to people that their premium is going to be really high if what they're trying to cover is the rainfall event that's happening every year now. That's not what insurance is for. That's where we need risk reduction, which is actually my point on the next model. Anyway.
So I get his question in many or any of the group contexts. How scalable do you think some of these programs are? I mean, obviously we're a big state with different risks all over. I differentiate that in some degree from Puerto Rico that has the full-blown insurance program that, I mean, to your point, if it's a Category 3 hurricane, everybody is going to experience $10,000 of damage. So I guess that's why they're comfortable just making the payout right away if it's a Cat 3.
Yeah,
But like, this almost seems niche to communities or local governments in some way. I mean, even smaller than local governments.
I think it's very niche, and I think that's a big problem to scale because you really need something in every community, and that gets to the difficulty too with the flood triggers. Because when we were designing the payout for this, we wanted it to cover intense rainfall flood. Well, there's not a lot of great ways to do that. The precipitation gauges that the government has are like out of the airports. And the city staff was telling us, we can have very different, these like big rainfall events that are just really specific. And that's not actually a good model. I mean, that's not a good measurement for some of the neighborhoods we are looking at. And then our data provider was like, let's use synthetic aperture radar, like satellites that can see through clouds. Turns out that's really hard in dense urban environments, which is exactly where we were working. And so I think the future of sort of the rainfall urban flood problem is the sensors, is using these like real-time sensors that are just picking up flood depths. And New York City is installing these on a lot of DOT infrastructure right now in a partnership with local universities that will measure flood depths on the road in real time. And I think those would be what you'd have to use. But then to your point, it's not like a Cat 3 coming through a small geographic location. It's like that calibration and pricing would have to be done each locality individually. So that's.
Should any recommend? I'm curious how you in New York or you in Philadelphia connected. Like, are local governments putting out RFPs for ideas, or is it something that maybe one of your groups that you've worked with has gone to? Like, if I'm a community or even a homeowners association and wanted to look into a derivative, who do I talk to?
That is
How
a
do I
super good
even get
question. It's
started?
not easy right now. We started the pilot in New York City a few years ago. When I was back at Penn, I'd been working with the Mayor's Office of Resiliency. It went through 3 name changes. I think that's what it was called. Or recovery. Anyway, that office, whatever name it was, on some of the challenges they've faced in meeting different needs after Sandy and what needs were not being well met. And we started having a lot of conversations about that. At the same time, some of these parametric models were getting more discussion. And so that's when we decided to try to pilot something and see how it would work. Once that pilot got going, now lots of communities have just looked me up. Like, how do we do this?
So Google.
I looked up other people involved in the pilot too. So we've talked to several. Yeah, I mean, and in Philly, we're talking with them through this collaborative, this called MOC that Rutgers is running in in Pennsylvania, New York, and New Jersey. That's how we connected with them and started these conversations. But it's like right now, nothing's off the shelf. So it's really hard for communities. And I think we need like a half dozen more pilots so that we can get to a place where it's like, this works. Like right now, the flood triggers are a mess. Like you can't just so we need more investment and work there. A team at Drexel has been doing a lot on these smart flood sensors, and we've been talking about how that links into the insurance, but yeah, that's not very helpful for you.
Very few states you can develop a parametric insurance product in today, separate from the derivative, right?
Yeah, the places where I know there's parametric insurance is this earthquake one in California, Oregon, and Washington. There's a hurricane one in Florida and Puerto Rico. There might be others that I'm not aware of, but those are the ones that I'm aware of.
Okay.
Yeah. And then there's also a whole other world that I don't know as much about, but of course is like the commercial parametric. And I think that's a little bit more widespread.
Other questions before she moves on?
Okay. Almost done. I just had one last model I wanted to talk about on this point that I was making before, which is if we want to make disaster insurance affordable, we really need to lower the risk. Like there's very little, I mean, we can do some financial engineering around the edges, which is what some of this conversation was about, but like, right, the price of insurance reflects the risk. So when the risk is high, the insurance prices are high. So we have a whole strand of work now on how can we get insurance to be a better tool for driving that needed risk reduction. And so one thing we've been looking at are these endorsements, which are extra coverage on your insurance policy to pay for risk reduction at the time of rebuilding. Now, they've been used along the Gulf Coast for wind building to the fortified standard, which is like the wind fortified constructed buildings. It's like hurricanes come through and they're the one that's like still left there. Like we know how to build strong, we're just not doing it at scale. And so the idea is once your building's blown down and you have to rebuild it, it's actually extremely cost effective to just build to fortified at that point. It's like an extra couple $1,000s. So just pay that extra money so that when we build back, we're building back stronger. You can click it again. It's harder for flood. And we know it's harder for flood because a lot of the mitigation measures are a lot more expensive. And so to have an insurance company be paying out a lot more to elevate a home, for example, it makes the economics work. Fortified, you could almost offer for free. But so that's a challenge. But you could create these types of endorsements on private flood or the kind of wrap around an NFIP policy in order to do that risk reduction at the time of rebuilding. The other challenge with flood, I think, and maybe folks in the room know more than me, but like, for example, again, coming back to the conversations we've been having in Philadelphia and in the community there where we've been working, there's a lot of smaller cost things that can be done for flood risk reduction, right? Like backwater valves and sump pumps and just moving appliances up out of the basement, flood resistant flooring, those types of things. And I think, I don't know if someone else here knows, but there's not like a big cost differential to doing those pre-disaster or post-disaster. Like with fortified, taking down a really good roof is like, doesn't make a lot of economic sense. Once your roof's blown off, like then it's really cheap to just build it stronger. But I think some of these lower cost ones, you really want to be doing them pre-disaster, not post-disaster. So you really don't want them as an endorsement. You want to be encouraging it ahead of time. We've also been thinking about this, is totally off topic, I'm just FYI, on using this so that when we rebuild, we're also decarbonizing the building sector at that time too, and giving the extra dollars to do that. Okay, next slide, last piece on this, which is also in the places where we know the risk has just gotten too high and it's not economic to continue living, how can we have insurance help those people relocate? Because we know there's not enough federal buyout dollars for everywhere in the country that's going to need buyout dollars in the coming decades. So there's been this thought like, well, maybe we can harness insurance to make the payouts and let people relocate. So in California, they've been trying to do this around wildfire, and their regulator issued guidance that if your home burns down in a wildfire, your insurance company has to give you every last dollar they would have given you to rebuild in place, to rebuild somewhere else or buy a home somewhere else. So that helps the person who really wants to get out of harm's way right after a disaster, who doesn't want to wait 3 years for the federal buyout dollars to come through, right? But there's nothing to keep that land. What'd you say?
Is that an exaggeration? Or does it really take 3 years?
It can really take years.
We've done it 18 months. We've done it
18 months is good. That's great.
No one's looking at
I'm like.
But you're right. There's some, 3 to 5 years, but there's so many reasons for it.
Oh, there's so many reasons. Yeah. And I think that's part of the problem is there's so many reasons. We did some work trying to figure out how you speed them up. And it's like, I mean, there's everything from like the reviews you have to do of the property to the negotiations, to like, it just goes on and on to even getting the dollars.
It's a voluntary program, so.
Yeah.
So,
but anyway, the problem with California, I just wanted to note though, is that unlike a buyout where you have to keep the land in open space in perpetuity to keep it from having future losses, that's not happening in these wildfire areas. What's happening in these wildfire areas is that it helps the person whose home was burned down, they move somewhere else, and they sell the property to someone else who just comes in. So it hasn't lowered societal risk. So we haven't figured out how to use insurance as a financing tool to get people out of harm's way and then put the land into open space.
Would it also pay for the cleanup, and it pays for cleanup and me to move? Or
no, it pays for.
I could move, but then I have.
It pays for whatever would have been fully included in the policy. So like if you had temporary living and you had garage and like other, like if you had a really nice homeowner's policy with a bunch of extra features, it would have to pay all of
It
those.
maxes the policy
It maxes
out.
it out, yeah.
Okay.
Yes. Yeah.
Huh.
But a lot of the way this actually works, right, is they get that payout. They use most of it to pay off their loan to the bank if they have a mortgage. Then they sell the property, use the proceeds from the sale of the property for the down payment on the new loan.
That's the problem.
Yeah.
They need to do that.
The
Because
person
that
buys it.
suggests the property to further development, unless somebody comes in, like the government buys it.
And buys it, yeah, and then we're back where we started, right? Yeah, so,
One more clarification, Dave.
So if the insurance company would purchase the land, because technically they would become the owner of the property if they gave you everything to go buy something new, is that a possibility? You know, in other words, think about it from a car standpoint. It's a total loss. The insurance company then becomes the owner of the car. And then the insurance company has the ability to sell that car for parts and everything to kind of recoup some of the money that they paid out for the claim itself. So would that happen in relation to the land?
that's not
Purchase.
happening, they're not taking ownership. Whether there could be some program where they should or could, and
then they
that
could-
could enable, yeah, and that they could be better as a holding and then work with
Yeah,
a land trust or commercial,
okay, I
yeah.
didn't know if that's possible.
Totally.
Okay,
Yeah.
thank you.
Yeah,
It's an interesting
the idea
idea.
that someone needs to buy.
Someone needs to buy it.
Someone needs to
Yeah,
buy it, yes.
Yeah.
That's the problem.
Yeah. Okay, just a couple other really quick things. If you go forward.
You're not time constrained, just don't worry about it.
Okay, I feel like I'm talking too much. Okay, I just wanted to flag a few other things that we've been involved in on flood insurance affordability that were not in this like parametric space. So the first was some work I did with the city of Portland, Oregon back in like 2018. And this would be a little bit different now, post risk rating 2.0, but they did this really neat program where they did household, which I know I've talked to you both about, but they did these consultations with households in this high risk, socially vulnerable area to sort of help right size the coverage and correct errors. And I will tell you, it was astonishing, the extent and nature of the errors in the flood insurance policies. They got a flood insurance expert to do one-on-one consultations, and then we reviewed all of them, and everything from like a home that was only worth $175,000 being forced to buy a $250K policy, which of course they don't have to like mistakes about the nature of the foundation and the height and all these like structural characteristics that on average, once those errors were corrected, on average, they lowered flood insurance costs for households by about $700 a year. So it was, yeah, really. And this was back pre-risk rating 2.0 too, where elevation certificates could make a really big difference. I don't actually know how much they would matter still. That would be the
We
question.
don't call it risk rating 2.0 anymore, do we?
No, it's called something else.
And if I be pricing approach.
The pricing
Oh,
approach.
just the price.
Eventually, there'll be a pricing
Build the doors
approach.
right there, buddy.
2.0.
Does that make it free?
Okay, well, I don't know how much this would matter in the current pricing approach, but pre the new pricing approach and the old pricing approach, the elevation certificates actually helped a lot because a lot of these were pre-firm homes that were above BFE and didn't know that they needed to submit the certification in order to get the better pricing. So this also just helped with a lot of like lack of homeowner awareness and literacy about the program.
How long can how much can an elevation certificate cost?
Hundreds of dollars. And what Portland did was they made them free for below a certain income, and then they made them low cost for above that income by doing them in bulk with a surveyor that they like employed to just go into the neighborhood once and do a bunch of bulk. So they got a lot of cost savings for it.
Okay.
And then they partnered with another NGO who did these home assessments that were for flood mitigation measures, but also for just like health and safety measures in the home too.
Property in their lives either.
Yeah, that's, yeah, exactly.
You know,
Excuse me, if you could please mute yourself or we can mute you. Yeah, thanks.
Anyway, so this was an interesting approach, and I think also speaks to the city, Portland, then worked with the state in order to get continuing education requirements for flood insurance agents, because they realized how many flood insurance agents were writing policies who really did not understand the program. Okay, next one.
That's where most of the errors originated. Either I'm buying direct and inflating the amount of coverage I need, or working with someone and it's still.
Almost all the errors here were agents who didn't understand the program. Yeah. I've heard that the new pricing approach is a lot easier on agents, so I don't know if you'd still see the same thing today, to be honest, I don't know.
Yeah, we'll allow it.
Bill Bradfield, FEMA Region 3, Flood Insurance Liaison. Ideally, yes, it has mitigated some of those challenges, but it's still, at its heart, it's a data entry. So if there are mistakes made at the agent level going into the rating engine, they could perpetuate through. Because I mean, I understand what you're saying, because even back when I was, city cog days, we had a house that was paying an exorbitant amount of flood insurance under the legacy method, but they had been rated as a commercial property, even though it was a residential property. And it's just
those types of
the
mistakes.
toggle of a button in there.
Yeah, we were just like.
And like, once we corrected it, it dropped it from like 2,000 down to 700. So.
That was exactly the type of.
Right, so those kind of
It's
things,
like a
and I've heard
mistake that-
stories, like you said, where the home is worth 150, but they're convincing them to buy $250,000 worth of coverage, so that goes back to the agent.
Right. Thanks.
Okay, I'm really getting to the end here now. I just wanted to flag a few more things. I think one avenue on affordability, under this heading of affordability and risk reduction, is to make the household level risk reduction things more incentivized through the NFIP. It is hard right now in the new rating approach to be able to see what types of structural changes are going to result in what kind of savings. And I think it makes it, maybe agents, I don't know what the role will be. I don't want to presume anything. I think it would make it hard for an agent to have any conversation with a policyholder about changes that could be cost effective. And then this is my thought, is that then you reserve the CRS for those community level mitigation things and the incentives to do that. Okay, the next one, I still just personally, this is just me talking personally, I think the best way to address affordability in the NFIP is a means tested assistance program set up by Congress. And I know that's been introduced literally every year in Congress for the last decade and a half, and they've never adopted it. But I still think that would be the easiest solution here. Okay, the next bullet. I already mentioned that, is that some people are, we've talked to some communities who are thinking about this so that people can get a high deductible. Okay, and then last slide is just, I just really, this is a little bit of a different conversation in Pennsylvania. We do a lot of work in places that are where the property markets are really in a lot of crisis right now. And I just think it's really important to always underlie our conversations that I've said 10 times now. So sorry for being on a soapbox, but like, we have to focus on risk reduction if we're talking about affordability. There's like no other way around it in my mind. So for what that's worth. Okay, that's everything I have.
What do you think, what are some strategies you've seen the state employ versus kind of FEMA or the NFIP? Like what?
For risk reduction or affordability?
Either.
I haven't seen much about affordability. The only affordability things I've seen is New York City had some ideas about it, did a bunch of studies, never implemented them. Syracuse, you might have read, had this interesting thing where residents could get a break on their property taxes if they were in this SFHA. I forget the exact things. Turns out like only 6 people ultimately qualified for it, so it didn't really help that many people. But yeah, and I haven't seen much else on affordability. I mean, actually stood up as a program as opposed to conversations. Yeah, but I do think that there's a lot of community decision-making around investments in flood mitigation that are driven by trying to get CRS points or trying to get the floodplain remapped because of a levee or like whatever else. And, so I do think it's incentivizing some types of risk reduction that way.
Other questions for Dr. Kuski?
Been very helpful.
Yeah, thank you very
Thank
much.
you.
Really appreciate it.
Thanks for the
And
invitation.
we have your slides, right, that we can share.
Now you do.
Perfect. Very good.
Yeah,
Thank
great.
you. Well,
Thank
you're
you so
welcome
much.
to,
Can I just
stick
move to
around.
the back of the room? And
yes, you can. Because up next, I think PID's Policy Director, Caroline Boehm, is going to talk to us about some of the initial recommendations that we tried to pull together based on our conversations and kind of taking the themes from the meetings that we've had. Wanted to put something on paper that we could start to respond to. I mean, we have right now, one meeting left because the report is due early July. So our thought was, I mean, we could talk through it today. If theoretically, if we get comfortable with a set of recommendations, we could vote today to approve electronically, not this language, but we could move forward where we'll fill out build on the bones of the report, put it together with recommendations, share it with the working group, and take remote votes. We can't dialogue about the draft, though, once we move out of the meeting. So like, we can't collectively draft it. It would be, I would send it out to members. If people had edits, I could aggregate them and send out a marked up version that then we could vote on if we feel like we get close enough at the end of today. If we want to come back in early June and kind of talk through them all, we can do that too. Those are just some of our options, but we tried to grab the key themes, and that's what we're going to kind of try to walk through today, so we can mark them up now, edit, add, reduce, whatever. So with that, Caroline and Dave, I'll turn it over to you.
So we just want to thank you all for attending each of the meetings that we've had. And I think as we've gone along, we've learned a lot about flood insurance and the potential for premium assistance. And I think that we've learned that it's more of a piece of pie than just one simple solution. So as Caroline and the team have been reviewing different ideas and recommendations, these are things that should look relatively familiar because they're items that we've taken from each meeting and trying to build upon what we learned. As Commissioner Humphreys had said, we could use these recommendations, or if we feel that we go in a different direction, we go in a different direction, but we felt that we wanted to have something to present to the team to kind of look at and see what we want to do. So Caroline, give it to you.
Thanks, Dave. Just for the folks in the room, I just want everyone to know that I'm sitting here so that Bill Bradfield can't see me. I know that he has a personal beef with this pillar here. Yep, so I'm just gonna sit here. It's great to not have direct eye contact. I'm just gonna echo some of what Dave said. Really appreciative of everyone's time and consideration. We've done a lot of work. There's lots of folks behind the scenes that have been willing to have conversations with us. So if you're one of those people, we really appreciate it. And so, yeah, let's dive right in. Karen, if you could get the next slide. So what we heard specifically in our last meeting in Yardley, we really heard about the CRS program, where CRS is really designed to mitigate risk. And I think what we have heard, and when we're talking about affordability, Dr. Kuski kind of talked about risk mitigation as a way to hit affordability. And I think you'll see the kind of the through line of these recommendations is we are trying to mitigate risk, assuming that you would presumably bring more carriers into the market, more people would buy insurance, it wouldn't be as expensive. So our first recommendation is to create an Office of Community Rating System Assistance to be housed within the Office of Recovery at PEMA. And we're kind of envisioning this as a Commonwealth-wide support. What we heard about the CRS program is it can be kind of an arduous process. It can be long, lots of paperwork, and lots of communities otherwise don't have the resources readily available to them. So we are kind of imagining this as to be the statewide resource, staffing one leader and then one person in each of the PEMA regional offices. Tom Hughes helped us draft this, so appreciate his input there. I also want to say before we get too far deep into the recommendations, we are presenting here today, but if at any point in time somebody has an idea on a recommendation as we're on it, please feel free to raise your hand and seek to be recognized by the chair of the task force. Do you have anything you want to add?
No, I think everybody should have received the more in-depth notes. Just want to make sure that you do have those. That's all I want to say.
So we're just going to go one by one,
Yep.
right?
Yep.
So
Yep.
any questions or thoughts on kind of the CRS office idea?
So I think it's a good idea, so I commend you for that. And I see under recommendation 1A, there's an expansion in PEMA grant funding. I guess the question, for me is, I heard a couple of things both last week and I know from previous experience, having an entity to help people navigate the program is critical, but also having some financial help in doing what needs to be done to qualify is also important, right? So I guess my question is that the thought on the is that part of the thought on increasing the funding, the grant funding?
Yes, correct. We are envisioning it as kind of another thing in the toolbox to bolster community-wide resources. So if that looks like, and I will say, we started with these recommendations kind of at a super high level, hoping that we would get some feedback that would help us kind of drill down on what the money would be used for.
Right.
Because I originally thought that maybe the money is used to hire a staff person,
Right.
or maybe the money is used to do some of this mitigation efforts, like acknowledging that that could be an extensive undertaking for an otherwise under-resourced community.
Right, right. Okay. And I think part of this, it would be helpful to have some idea of like associated costs.
Sure.
Because ultimately, if these are going to wind up as recommendations that we suggest the General Assembly adopt, knowing the fiscal impact is going to be pretty critical. So.
Do we know where it's funded at today, the grant program?
The municipal assistance program,
Yeah.
it's DCD, has oversight on that.
Okay.
We could certainly mock up some numbers and try to get something more granular available.
Because we could come up with numbers for how much one supervisor and three, I mean, that part would be easy. It's just, I think, this modeling and mitigation and assistance, having an idea of kind of the full spectrum of what we would potentially.
Yeah, because I guess what's described here on page 2, printout that I have, seems to be less, perhaps not as directed toward potential capital costs. And I think that's a big chunk of what we could be talking about. I think that should be woven into the.
Yeah, absolutely.
Other thoughts on modifying 1 or 1A? Yeah, we'll go out.
I just wanted to contribute again, Bill Bradfield, that along the lines of the staffing and the money, the states that we've seen that do the best with CRS and promotion are the ones that have really strong CRS users groups that I think that this could play into, where if you set the folks, if you have the positions there that can help coordinate those efforts, then naturally, as you get more organizations or more communities into this, they can build off of best practices. So I just wanted to communicate that. I think that this plays in nicely to that, because I know Virginia has a very strong CRS users group.
What's a users group mean?
It's just all the CRS communities get together for calls monthly,
Okay.
quarterly, but it's an information exchange, but this could help facilitate that and kind of just perpetuate itself.
We have one, but it's not real strong.
Okay. How often do they,
It's
you
like,
know what they do? They just periodically meet and talk to them.
left the main person is the resilience officer for Columbia County that gets them together as, and he sends out the CRS, user newsletter, the user letter. You know what I'm talking about, though. Basically, and if they have problems, they talk to each other. But what he's talking about is the next level, to where, have an administrative agenda and all that set up.
Is that staff, that's still staffed by a user? Or is there someone within Virginia that organizes that?
Yeah, so in Virginia, it's really Wetlands Watch is the organization that kind of spearhead a lot of the CRS in terms of the coastal lower areas. So
Okay.
they're not a community, but they are an entity that also helps with other aspects of grants and but they can facilitate that to take the burden off of the communities.
Other thoughts from members on the phone or in the room on 1 or 1A?
Yeah, this is Mark Grahusky from Senator Baker's office. Similar to Senator Sanacero, Senator Baker has concerns about the cost of recommendation 1 and 1A, and also the location of where the program would be administered, specifically whether that would be better served in DCD rather than PEMA. So those are some additional clarification she would need to support that recommendation.
Just, and she would prefer it be at DCED, or is just looking for more clarity on where we would.
I think as it's currently explained, it seems to sink and would find a better home under DCD, but once she sees the cost and some additional information on it, perhaps the next session we have, she can delve into it in a little bit more detail.
And Tom, I guess my question to you, as we kind of think about DCED and Pima as potential locations, Pima, what does Pima do specifically on CRS today? Because obviously, I think we don't want to duplicate efforts. So trying to think about where this office would go.
Yeah, I mean, there's 29 right now in the state, and we work with those, do the community assistance visits. That's under our office. It used to be under DCD. As far as the outreach to them, as far as trainings and that, we reach out to them. Trying to get them to, go to the next class.
DCED?
No, being the locals.
Okay. But it used to be at DCED.
Right.
And the function
And it used to be
over to Pima.
Right, and moved over, and it was a good fit because we're dealing with the floodplain managers, and that's our number one risk in the state. So we're working with the floodplain managers, working with the county conservation districts, the county planning already, and HM planning, the EM coordinators, the local EMCs. So,
okay.
And the next step is, get more communities into the CRS program. That was the gist of this with those communities that we're working with right now.
So it sounds like Pima's already doing a lot of that work as it is, and not DCD.
Right now, I
Right now.
would say it sounds like it.
So it seems like there are two issues here,
But the
right?
grant is separate.
The grant's a separate
Right.
thing. So I'm thinking the coordination, the help probably makes more sense from Pima, since that's your wheelhouse. Whereas the administration of a grant program, maybe that's their BCED.
And that would be a good, maybe, just from what we've seen, with the municipal assistance program, there used to be funds for floodplain management. But when it moved over, there wasn't. And so it might be, hey, like you're saying that, they got to get something to get there. And so if they can use that as an eligible expense to stand up a CRS program, because once you get it, the maintenance of it, pretty much you have the admin in place for that. It's just, maybe they could get up to 3 years trying to get to where they need to go. I mean, I think of Yardley, I think of town of Bloomsburg that have gone through that process. They kind of took it out of pocket. And so, how do you incentivize that to have more communities do that?
Okay. And again, just to clarify, there's an administrative cost, but there's also potentially a capital cost. If you're going to do backflow preventers on a large scale, if you're going to do a levee, if you're going to do a number of other things that could have an impact on mitigating the risk. So.
Other thoughts on 1 and 1A? So I think we'll go back and build them out more from a cost perspective, add some more detail on what 1A would look like, so we get more that we can react to and respond to for the next version of the template or the proposed recommendations. Okay. Hearing no more on that one, let's move on to number 2.
Another thing we heard was that the disclosure process when you're buying a home is maybe not as robust as it could be. There's a National Resource Defense Council report titled "How States Stack Up on Flood Disclosure." We are currently rated as a C, which is adequate. Neighboring New Jersey and New York are rated at A. And currently, the current PA law only requires the seller to disclose to the buyer whether the seller is aware of any past or present flooding issues, or if any part of the property is located in a high risk flood area. As you can imagine, if you're somebody who lived in a house for a year that did not necessarily witness a large scale flooding event, that doesn't really encompass whether or not the property actually does have a large flooding risk. So we are proposing to adopt much stricter disclosure standards. So there's a few listed there, but whether the flood property is wholly or partially in the FEMA mapped 100-year or 500-year flood zone, if the property is required under federal law to carry flood insurance on the property. And there's a whole list that is included in that packet that would really kind of grow on what our current disclosure is. So hopefully when a home buyer goes through the home buying process, they're not surprised at closing with a, hey, by the way, you need flood insurance, and also it's gonna be $1,000 a month.
So I'm not sure whether it fits here or under recommendation 4, but I think the point about errors in policies has to be brought in someplace. Right sizing coverage, all those things. And so, whether that's done generally in the disclosure process or whether that's done more in education of homeowners and home buyers.
Well, I think part of that might be recommendation 3.
Yeah.
Where we're going to require specific continuing education on flood from the insurance agents, the realtors, and the banking community.
Right, which I think, and I saw that too, and I think that's good, but I guess the question is, how do we know that the home buyers are actually buying the right?
And I think you're right. I mean, going into the 4 and the outreach, if we can't send somebody out to every homeowner in Pennsylvania to work that has a flood insurance policy to review it, but if through that education to the actual homeowner so that they can learn to understand their own policy and not just be relying, on whoever's presenting it to them to make sure that all the data was entered
Right, I mean,
correctly.
hopefully 3 reduces the problem.
Yeah.
But to be more certain that we're actually.
And we'll go out of session for a minute. Carolyn, remind us how Portland did it. They funded a program, I imagine, that people would go out and work with homeowners to look at their coverage.
They funded a program in a neighborhood where they contracted with a flood insurance agent who they knew was a deep expert in NFIP and private flood, actually. And that person did one-on-one consultations, but yeah, to the point that's not scalable or sustainable to do across like an entire state.
So, I mean, some of it is awareness generally on the consumer side, some of it's education, and even awareness that PID exists. I mean, we're happy to work with homeowners that have questions about their flood coverage and.
Yeah. I wonder though whether some kind of like interface or portal, online portal could be developed that would help at least in this regard. Maybe not to the level of having an expert come and actually review your policy, but maybe where homeowners can put information in and there could be some kind of you're in the zone.
Or even maybe a checklist with the common problems that were found, have you checked your policy for this? Have you checked your policy for that?
Yeah, if I have a $150,000 home,
Yeah.
I don't need $400,000 in flood cover.
Right.
Right, how we can catch that. I mean, theoretically, I would hope the agent wouldn't make that recommendation. I would hope the company wouldn't provide that coverage. Or I would hope that if Dave found out about it, he would knock on doors about whether they would appropriately write that coverage. But yeah, I think the challenge is reaching them before they make that decision for a while.
The elevation issue, a lot of those things can be common problems that just,
Yeah.
Well, and they can change
right.
over
That's it.
time.
Right.
So what was right when the policy was written might not be right every single year. And usually insurance agents put it onto the homeowner to, review their policy limits and what's going on in their own policy.
Well, I mean, quite honestly, I think a lot of people don't have a conversation at renewal. You get the update on where your premium is going and you continue to pay it because it's auto paid. And you maybe never even looked at what the coverage looks like again. You thought you knew it at the beginning, but then you just continue to pay the premium.
Same with the cable bill.
Yeah, right. I have no idea how much the cable bill is. But I keep paying it.
Yes.
It goes up $20 every year.
Yeah.
Right. Let's look at 3 and 4. We'll think about when we go to 3 and 4 in that context.
Right.
Let's come back to that. Let's focus here on this piece. Did you have a question on 2?
I was hoping we weren't, are we moving off of 2 right now?
No, we're coming back to
Okay.
2, and then we'll bring that into 3 and 4. Because 2 is effectively the idea of beefing up the information that's told to the
Right.
homeowner earlier in the home purchase process.
And I think that's critical. I mean, that's critical because, the seller, in most cases, no, they do know, but there's differences on how they disclose based on, what they're filling out at the time that they're listing the property, right? And I'm almost wondering, and I don't know if New York and New Jersey did this, but are there, and I don't even know how this system works, but are there capabilities of actually getting the flood certificate at this point when they go to list it? I know that there's other requirements across the states for other matters like, radon or smoke certificates. Is there a way to get the flood insurance or that flood cert earlier on in the process, maybe at the listing time where they have to show it to the realtor and I don't even know if a homeowner can get that. I don't know if it's limited to certain professionals that can obtain those types of flood certificates.
It's a good question. I don't know either if and when you could get a certificate somewhere.
The elevation certificate. You're referring to the elevation certificate?
I'm referring to and I know that there's a flood certificate that shows whether or not it's in one of those flood zones. And that would identify prior to, selling whether or not they're going to be required to get flood insurance if they have a mortgage. But if they don't have a mortgage, at least it would show the home buyer, look, you're in this floodplain. Whether or not that means anything these days.
Right.
Or if it's enough, I'm not sure, but
Is that bullet one here?
I think it's one, but that's this, I don't know if this is just limited to the seller's knowledge and how far they would have to go to show that knowledge.
It says it must disclose, so there has to be, so I guess the issue is what's the vehicle for disclosure?
Or when does the disclosure occur?
Right.
Do we know when New York and New Jersey required it? And I
No.
guess we could look back at
Yeah.
their legislation to look more specifically on timelines. And,
Yeah, whether it's at listing or at the time of
right.
sale, or if it's at the disclosures that you complete when you are getting ready to list.
Other thoughts or questions? So we'll look at their statutes, see the specificity that we might want to incorporate into our recommendations. But other thoughts on the disclosure process? Which I think when we had our stakeholder meeting, I don't think anyone really opposed the concept of earlier and more full disclosure.
They shouldn't be hearing about it at closing.
Right.
No.
Or they shouldn't be hearing about it when you can force place into a policy.
Let's go out of,
Am I allowed to do that or no?
we can allow it. Yeah, well,
We're not a stickler for the rules.
no. So we're going out of session to allow comment. Go ahead.
Sorry, I think I really like this one. I wanted to just offer a couple of things. There are places, the disclosures, and as far as I understand them, in New York, New Jersey, and also North Carolina, South Carolina, and Florida, all of them in the last year to 2 years all upgraded their disclosure. So there's lots of good examples now of doing this kind of reform. And all of them, I think, are disclosures when you go to look at the property initially. So it's not closing. It's like they have to be there when you go to tour the house or whatever, right? So it's earlier in the process. And one thing that the research has shown is that it's really helpful if the disclosure has something that's beyond the SFHA. So the things listed here, like, is there insurance? Are you required? That's all just SFHA. And some of the biggest problems are flood risk that exists that's not SFHA. So something like prior knowledge of a prior flood or something that would capture that risk that might not be on the map. And then the other thing about an online lookup tool, I'm really optimistic about the future of online lookup tools, but right now Risk Factor has integrated all the FEMA maps. And so you can enter any house in America and get the FEMA flood zone through Risk Factor. Just an FYI, not to put into any kind of statute, I was just telling you, so.
Is that a FEMA website?
No.
Risk Factor? No, it's a private website.
Yeah, they took digital maps and overlaid them.
I'm just wondering too, back to your point, maybe proximity to the water source. Because that's what,
Yeah.
we're not calling it risk free 2.0, we're calling it pricing. And FIP pricing, I mean, to know how far they are to that water source. Some may not even know.
Can I put my address into the FEMA website somewhere and it would tell me if I'm in or out?
Oh, yeah, I mean, we have a fully facing, the Map Service Center and the National Flood Hazard Layer are public sites where you can go in and they work like Google. You type in your address and it'll drop a pin and let you know whether or not you're in the floodplain. And then you can Pennsylvania has, all those, all the
Flood tools
states have their own flood tools as well. So it should be easy information to find. A lot of counties have their own flood tools as well.
So maybe we can incorporate some of that after we look at some of those statutes to see what specificity we think would be helpful. Because I think that the general consensus is earlier is better. Yes, what you know, but also if there's data that can be pulled, I think would be helpful as part of that disclosure. Other thoughts on recommendation 2?
Commissioner, if I may, follow up just on what was said. I will invite you to test it. The risk factor is actually extremely easy to use.
Okay.
The FEMA, and no complaints about FEMA, but I think it's less user friendly. So in terms of disclosure, I think it would be good for you to just type in your address and just the risk factor gives you a grade. Now, I don't know the credibility. I think initially we had talked about it after the first meeting, you had said it was legitimate. But of course, if there's no control over who owns it, maybe over time it's a problem. But as far as usability, I think it's there's a big difference.
Okay.
Rather than not reading on that.
Got it. Okay.
Sounds like there's some folks online with some questions.
Okay. Can I see that? I'm gonna have to stop doing this, but yeah. Who has a hand?
Good afternoon. This is Chris Ramsey from Senator Baker's office. Do we have any sense of when the disclosures section of law was last updated with anything? Did we come across that?
Seller's disclosures.
The seller's disclosures when it was last updated. I do not know that. We can look at that and send that out to committee members. Thanks, Chris.
Thank you.
Do you have a follow-up with that? We'll find that out and we can share it with the group. But any other thoughts on that piece?
Yeah, I just, obviously that's something that if we have any sense from the realtors, if they have any concerns there or maybe they have perspective on that as well.
We mentioned those neighboring states on the panel that included the realtors, and I don't remember any objection. But obviously they'll have time to kind of go back and look at it. Okay. Let's move to recommendation 3.
So a few task force meetings ago, we welcomed panelists here to kind of talk about this flood insurance landscape across different professional areas. And we heard from insurance producers, mortgage lenders, and real estate agents, and kind of really were able to dig deep and to kind of assess what their current training level is like and what their continuing education is like. So this recommendation would incorporate 2 hours into existing structures. So whatever in that professional line, whatever you're currently required, if that's 24 hours, it's 30 hours. We are not proposing to add 2 additional hours. We are simply proposing to repurpose 2 of those hours to be focused on flood insurance, risk mitigation, flood risk, et cetera. And so it is our hope that you would kind of tackle some of the maybe the miscommunications or otherwise misinformation that's around flood and flood risk, and that these people would, I think another thing that we heard a lot, especially with people, mortgage lenders and real estate agents, is that they weren't necessarily comfortable engaging in conversations about flood risk and flood insurance for fear of regulatory overstepping or maybe a lack of information. So hoping that we can kind of meet people where they are and increase their knowledge and kind of mitigate some of this misinformation or otherwise false perceptions of risk that are going on.
Completely agree it's necessary. Is it a suggestion for 2 hours one time or 2 hours on a regular basis?
It would be part of their continuing education credits. So if you're a licensed producer in Pennsylvania, you have X amount of hours that you have to complete every 2 years. So it would be every 2 years, kind of like you would take your first one, but then imagine it would be a refresher for you.
So I think that maybe we could consider a different weight of the number of hours for insurance and real estate agents versus the mortgage lenders. And the reason I'm saying that is usually when somebody gets to the mortgage process, it's too late. The emotions are high on a home buyer. And not only that, but it really is out of the realm of the purchase, that part of the purchase experience outside of the need for flood insurance to protect the lender. So that should be the limit of the mortgage broker or lenders sort of education into it, because there wouldn't typically be the person to suggest it's too late. Emotions are high, they're at the table. It really shouldn't be something that they should be discussing with a potential home buyer. But then when you get to the insurance producer or even the real estate agent, those are the ones, earlier on in the process, or even for those that don't have a mortgage, that's where it's more important.
So you're thinking like a one-time, 2 hours for mortgage lenders, but the others would be kind of ongoing? Is that the idea?
Or even, yeah.
Do you happen to know what the CE is for mortgage lenders? I don't.
I can find out pretty quick. I can find out and let you know.
That'll be helpful.
I don't think I think the people on the ground most directly related to the policyholder are the realtor and the insurance agent in this case. So, I think they need it on an ongoing basis, but I see the point on mortgage lenders. Other thoughts on number 3?
Thinking on the mortgage lender. Sorry, John Savant, INB. I do know, like, with trying to think back to when I bought my house, I do know sometimes a mortgage lender can be one of the first people you talk to, because you go and you get your pre-approval, and then you go out and find an agent or find a house. So sometimes they are the first point of contact.
But they have no idea what property you're looking at.
That part's true.
That time they're just looking at how much they'd be willing to front for you as part of that process versus kind of where you'd be looking. Yeah.
I think part of another through line, if we're talking about risk mitigation, another through line for these recommendations is just increasing the touch point that flood insurance has with somebody in the home buying process, or just a renter, a homeowner, to just increase awareness, because I think what the conversations that we've heard, people's perception of risk is vastly different than what their actualized risk is on a property. So if I could look at Dave and tell him 100 times, like, you're like, it doesn't matter that you're outside of the SFHA. If it rains, it could flood. It doesn't matter. He might be like, okay, Caroline, whatever. I never lived through it. It's not going to happen. I'm kind of seeing a lot of these recommendations as almost like, what's the threshold at which we can tell people you need flood insurance, you can get flood insurance, and is it the 10th time at that touch point, then they're finally like, you know what, I should get flood insurance. If we can't get them to understand their actual risk, maybe we can tell them enough times that they'll be moved to finally buy flood insurance. So I actually mean that with all sincerity, that we're kind of going up against human psychology here. So I take your point. I think it's well-founded. I still think there's a necessity for mortgage lenders to feel, I think adding the continuing education credits will allow mortgage lenders to feel more comfortable even having the conversation. Like, yeah, you need flood insurance. And even if the conversation is 5 minutes, just arming them with the knowledge they would need to kind of engage in that conversation. So that's just something I wanted to say as the conversation has kind of developed, that some of these things may seem redundant or otherwise unnecessary, but we're kind of just trying to encourage the uptake of flood insurance by just getting almost in people's faces, like, here it is, please buy it, please buy it. So, yeah.
Other thoughts on the CE piece? I think some of the thoughts we had earlier, I think, come into number 4, but unless, I don't want to cut off conversation on 3. Okay, let's move on to 4.
So 4, we again kind of left like super high level bird's eye view. We're envisioning PID with FEMA and PEMA. I know that PEMA and PID actually both do lots of work on increasing awareness around flood insurance, but kind of this one felt like an easy win to put in, like whether that's bolstering an ad buy, a media campaign, tabling at local events, going out there and kind of doing a consumer services kind of focus here. And we included that outreach to include partnership with state legislators, state agencies, county commissioners, local municipalities, and even libraries as a community resource to kind of like meet people where they are. So acknowledging that we don't have anything like, there's no media ad buy that's illustrated out there like the NFIP does in the near miss flooding zones. We just wanted to put it out there that this is what we were thinking of and open to ideas and like what an outreach and education campaign should look like.
I wonder if this might be where we talk about some sort of increased educational presence, be it, I don't know if it's an online portal with Code PA that we would work on, or I know we have a number of flood materials already for consumers. I just wonder if there's something here that we can piece with the increased education of the professionals to help individuals make the right decision for their homeowner coverage, flood coverage.
So I will just say at the insurance department, our communications director is back there and he's working on a flood campaign right now currently. So I'm envisioning those are kind of the things that we're going to want to kind of incorporate in this recommendation, acknowledging that it already is going on in a lot of ways across the Commonwealth, but how can we build upon that and make it better, make it stronger?
Did I see a hand from a proxy?
Yeah, or it's not a proxy, it's from CEDACOG, Geraldine.
Hi, good afternoon. Considering any duplication of efforts in talking about the community rating system, a part of the CRS program is for communities to undertake annual outreach that can happen to the overall community by way of, a notice within their, sewage bill or a garbage bill, something of that nature. There's also outreach that can occur in repetitive loss and severe repetitive loss areas within the community. So just in thinking about education and outreach, maybe it could be a consideration to look to the CRS program for the boilerplate kind of templated materials that's already available that CRS communities are already promoting.
Think about that in context.
Just to add on that, we only mentioned, that there's 29 CRS communities. I think this ought to be maybe an initiative for all municipalities that we add on their webpage, something about, flood preparedness and resiliency.
On whose webpage?
On the municipalities' webpage. You can go to some of the municipalities and they may have a flood threat, but unless they're in the CRS program, that's where there's a requirement to have that in there. If we could do it maybe across, statewide somehow, to where we give them a boilerplate and they're able just to rack it right on their homepage.
Oh, like we would offer the template for what municipalities could use.
Right.
In the context. Okay. We'll see if that fits better in 1 or 4, but I think that makes sense. To have a template that communities can use. I think Director Patfield raised his hand. Go ahead, Randy.
Thanks, Commissioner. I think this makes sense. I think the one thing that I would like to see with this recommendation, I know that we discussed this internally, and I know that we've had discussions with, your office in the past regarding this, is getting this to the point where it's really targeted to the folks that we can have the conversation with. As the doctor indicated, when she was discussing flood insurance, this only resonates with individuals that, number one, have the disposable income to be able to afford the flood insurance. And I think we really, when we look at education outreach, we really want to have a very targeted program that is really educating those folks that have the ability and the capability to be able to afford flood insurance and to be able to insure against their risks, as opposed to, trying to just do a broad outreach campaign, in totality. I think some of that makes sense. I think what Tom indicated about, making sure the municipalities have information available, those types of things. But I think this conversation only resonates with individuals that have the ability to be able to do that. If they're not able to put food on their table for their families, this is not a conversation they're open to on this side. There's other things that we really need to talk to them about. Is there any mitigation we can do now because they can't afford flood insurance? Can we, look at repositioning appliances and heating plants and those types of things, given the situation, as opposed to, having them being able to afford flood insurance. So just something I bring out here because I know we've had these discussions in the past that we all have limited resources when it comes to outreach and education. We want to make sure we have the best, we're using those limited resources to the best degree possible.
That's one that we could take back. I mean, the report is meant to be both one that goes to the governor's office and to the legislature. So I think the first three are generally legislative changes, and this is one that we can beef up on the administration side on more specificity on where and how we think that recommendation should come out, and see if there's any consumer-facing tools that we can talk about in addition to the complement that we already have to see. I mean, it's in some respects, it's intended to be a list of recommendations. I mean, it doesn't necessarily need to be a wish list per se. That, I mean, there should be some reality to it. But certainly we can look at how we can make the consumer experience better as state agencies as well. Okay, why don't we move to 5? Because I think we've got some takeaways on 4.
So this next one is another kind of risk mitigation tool that we would introduce legislation to require insurers to establish a premium discount or credit for water damage mitigation efforts. And Dr. Kuski kind of hit on some of these, like water shutoff valves, water leak sensors, other things that would indicate that, flooding has started to occur, and translate that into premium discount programs or credits for homeowners policies. You would think we have other things in here about policy endorsement and riders that we'll get to that this kind of is married into.
And this would be similar through legislation today. We require discount programs for seniors that complete senior driver safety courses. So we were trying to draw a parallel there to kind of the homeowners context, and when you're taking mitigation steps, rewarding that policyholder in some way. I mean, 5% isn't a lot, but I mean, it's something that recognizes the work or installation that you've done to try to minimize some of that risk. So any thoughts on this piece? And again, this one would ultimately be legislation, I think, because it would require that credit from the carriers.
I think it's fine for what it is. I mean, I think it's an important part of trying to mitigate risk. But it doesn't have as direct an impact on the affordability issue.
Yeah. Any thoughts from members on the phone or delegates? Okay, let's go move right along.
Yeah, 5A is kind of expansion on 5 that would require legislation to provide tax credits or deductions for retrofitting a home to a stronger standard. So again, kind of rewarding the policyholder for undertaking certain mitigation efforts in their home.
This one is modeled after a number of, I think, Gulf Coast states and or Southeast states like South Carolina that has tax credits for when you fortify your house up to certain standards. Now, in those cases, fortification's a bit different because it's windstorm, it's hurricane risk versus flood risk. But it's my understanding that IBHS, which is the Insurance Homes, I forget what it actually stands for, but the home safety group that kind of tests and studies mitigation and kind of disaster loss has developed a flood mitigation program. It's my understanding that we can look to provide assistance for individuals that build up their homes and offset it in some way. We suggested an income tax credit of some sort, but I don't know that it needs to be there. But just trying to give some sort of again, benefit to a policyholder that strengthens the resiliency of their home.
I think it's a good idea.
And there's a number of, I think, actually currently federal legislation that would look similarly on mitigation efforts. I don't know that they have legs, but I'm actually on a call later this afternoon about some of those proposals and kind of whether in this case, the NAIC would support them, and we're looking at it. Any other thoughts on home mitigation measures from the phone? Okay, number 6.
This would also probably require legislation that would require insurers to create policy offerings that enhance or expand coverage provisions. So we have carriers in Pennsylvania that they're essentially riders on a home insurance policy that would cover some certain small amounts of water damage relating to flood. So water overflow, sewer backup, sump pump failure. And we're kind of envisioning that PID would have a collaborative effort with insurers to kind of identify the best practice in these expanded coverage provisions, understanding that the risk is often high, but we have carriers who currently engage in this type of policy offering. So hoping to expand those. So you're not, if you're otherwise uninsured with the flood insurance, you would still receive some type of, financial backup from a water-related rider you have on your homeowner's policy.
And I think this one, separate from the legislation, though, this one could be more, it ties a little bit to the education piece from the department. I wasn't aware that we had mutual companies that would write 20, 30,000 of risk for $50 a month. And as we know, the average flood claim is what, $25,000. So theoretically, some of those lower dollar risks can be addressed, that we can work to encourage, to talk to our licensees on the availability of those products and encourage others that aren't currently offering them. It doesn't necessarily need to be a legislative mandate that they do provide it as an optional endorsement, but we can certainly encourage it on our side and make consumers aware of the opportunity to purchase. Any thoughts on question or recommendation 6 or any modifications? Anyone on the phone? Okay, I think there's a 7th, right?
Yes, so I will say, task force members, you did not receive 7 and 8 because they were kind of last minute additions. Somebody let me have thoughts, which maybe they shouldn't. So we are going to talk through them with you, very high level, super quickly, and then we'll get something written for you guys to review. Recommendation 7 is, I think, a really easy one. So we were in a meeting where somebody identified that potentially a place to increase flood resiliency, and again, this is more of a mitigation thing, is kind of getting at the Uniform Construction Code that's administered by the Department of Labor and Industry. And as I was talking about it, I learned from Tom Hughes at PEMA that PEMA has actually been involved in the process of adopting the new Uniform Construction Code. I think FEMA had adopted in 2021 new flood resiliency provisions that PEMA is something the Appendix G is modeled off of when they're trying to get the Uniform Construction Code adopted. So we are just recommending that FEMA is engaging in an effort to get flood resiliency into this most recent Commonwealth-wide Uniform Construction Code, and we're just recommending the task force support them in that effort.
And I bring it back to PEMA. If you could talk us through, because as I understand, we're about 6-8 years behind on our construction code. Is that right?
On the Appendix G, where we're talking about flood resistant material. We adopted a portion, the state can adopt portions of the building code each year.
Who adopts it?
It's actually the state and the locals, and locals enforce it. We have the review committee, going through that process right now. Because, we're going to be hopefully moving from 2018 to 2021. We're always behind. It's just the way that's set up.
They're also the ICC is only ever published every 3 years. So from 2018 to 2021 is technically the most recent. So they're in the process, the RAC is in the process of adopting the 2021 ICC right now, like as of a week ago.
The ICC, and the ICC, or what about, who is the state that adopts it? Like which?
The RAC, there's a review committee, the RAC, that moves the recommendations from that RAC committee to L&I. And then they make the recommendations in L&I.
So the RAC recommends L&I, and then L&I
promulgates the new, yeah.
Is it a reg? Do they do it through reg?
Yeah.
Okay. So that's outside of the legislative process?
Yeah.
Okay. And we can get more information to the group on I think, that request. So we are more informed on what that recommendation would be. I mean, to me, it makes sense to update.
I'm trying to be more resilient to flood events, so.
Would anyone oppose that?
Well, there might be, some folks that oppose that too, but our building costs are,
Because when you update a building code, the building community.
yeah, there's certain, sectors that would be against it.
We had a requirement, well, they got rid of the requirement for residential sprinkler fitters.
Yeah.
Sprinklers, so that was a,
It will probably increase the ordinance of law coverage.
Do we have any idea, Tom, do you know how many states have already moved to 2021? Is that
I'm sure
something that we
it's
could?
probably International Codes Council probably has that on their website. Is that what? Oh, the building code assessment, yeah, building code assessment. Yeah, that has that on there too. Yeah, Bill, you're right, yeah.
Yeah.
Building science, that would have it.
Let's see what we can do to pull together more information on that process, and where other states are in the process, to see what we may or may not want to recommend in that space.
There's some states that don't have building code
At all.
So I don't think we want to go there,
But then states point to Florida as having a pretty strong statewide building code, despite the challenges that they have otherwise. Okay. And then I think you were wanting to, oh, go ahead.
no, I'm sorry, you're up to 8 or that
Yeah,
was-
we're up to 8. 8 is, if you get the next slide here. 8 is I will preface it by saying it could potentially be a little pie in the sky, but that's, what the task force is here. We're here to deliberate and talk about, what could be good ideas to increase uptake and affordability. And again, keeping this one super high level, because we're hoping that the conversation today can kind of inform where we go with this. But it is an idea to create a state flood fund designed to provide financial assistance for homeowners who experience loss after a flood event. And this idea was kind of born out of, so if you look at folks who have NFIP policies versus folks who don't, the average payout in Hurricane Ida was $45,000. And you are entitled to a small business administration grant when the president declares a disaster. Otherwise, those funds are not activated. So if you're an NFIP policyholder and there's a disaster declaration, you're probably just going to file a claim against your NFIP policy. If you are uninsured, you can file for a small business administration grant. I think the average payout in Hurricane Ida was around $2,000, which in the grand scheme of things, if you're experiencing catastrophic loss, I don't even know that would replace your flooring. So the idea was kind of to supplement that grant funding by creating a similar structure at the state level that could be pushed out for financial assistance in the absence of a federal disaster declaration. That was the initial sell or the initial idea, but
It is. I mean, and we've all had the, I guess, I don't know if it's the privilege of going through different communities throughout the Commonwealth that have had significant damage, but they don't meet the qualifications for that the declaration. So that's kind of the concept.
So, if I may.
Yeah.
So when I first wrote this legislation back in 2015, this was one of the main ideas, but the idea, it was keyed to kind of the CRS model. So it would be available to homeowners and communities that had taken the step of helping to mitigate risk as another incentive for that.
Yeah.
So I'm all for this, and I know this is, creating a fund is always going to be an issue with the General Assembly, but that's part of our job, is to advocate for things we think make sense. But I do think it's an opportunity to provide yet another incentive for communities to do the right thing to mitigate risk. So I would be in favor of somehow tying into that.
When you were thinking about it then, did you have, who was the audience that would receive benefit from, it was directly to a homeowner after?
Yeah, again, this arose back at that point because FEMA had changed the maps. Bigger Waters had removed this, the subsidy or drastically reduced, and then people were suddenly in this situation where, okay, we just had these horrible flood events and what are we going to do? And they had no way of, affordability was really the issue. So the idea was providing for the state to step in to some extent where the federal government was stepping back. Obviously, we would never be able to do, we don't have the wherewithal to do it and necessarily to do, completely replace it for Pennsylvania residents, but that was.
And I think some of the members or your staff may have participated in, we hosted a FEMA Region 3 meeting last couple of days. And I think during that meeting heard from Alabama about their state fund. Do we have any more information about what Alabama does?
Alabama does, I think the program is called Strengthen Alabama, and it's not means tested, it's first come, first serve, and they funded it via an increase on the DOIs, the Department of Insurance fees. And it's up to $10,000 per homeowner for fortification of their homes for wind, because they're a Gulf state, so that's their risk in wind is much higher than ours is. Those are the super high level details I have at this time, but it is again a mitigation tactic. But theirs is it's not means tested, so anybody could have access up to $10,000.
And it is truly first come, first serve. And once the money's gone,
it's gone.
It's gone.
That's not necessarily the best approach.
Yeah. And at the time when you were coming up with it, was there a funding source? I mean, we've internally started talking about different ways you could do it. I think the challenge with anytime a new tax is a challenge.
Yeah.
Particularly a new tax on insurance companies because we states retaliate against each other.
Right.
So if we impose a new tax on a P&C company, every other state will start retaliating against our domestic P&C companies. That will make certainly the legislator's job more difficult if you're trying to debate this legislation.
Right.
But so we talked about like a $1 fee on like DMV transactions, registration type thing, but didn't know if anybody else had thoughts on how you could fund something.
You have to remember in 2015, we weren't sitting on $14 billion in surplus. We had a deficit. So it was a very different environment. So now the discussion never really got too much further.
Okay.
Yeah. So.
But that's probably something we would want to recommend, you think?
Yeah.
And be at least a little more specific in coming to the legislature.
Right. And again, to my earlier point about fiscal impact, having some sense of what we think, based on loss, based on what we know about the state, a reasonable number might be, to have an impact.
Other members on the phone, any thoughts on a state fund? Recognizing that we have more math and data actually to pull as part of that process.
Could we maybe put on the list that not state funding, but federal funding that we might be able to access? That would take some legislation like Maryland did. There's a Safeguarding Tomorrow revolving loan fund program that we would need some legislation to allow us to access that.
Say that in another way.
It's called the STORM Act. How we actually set it up, the Safeguarding Tomorrow revolving loan fund program.
We just need some enabling legislation at the state level to be able to access it.
Right?
And it doesn't require any sort of state match?
Well, it can be used as match too. So you can cost share it with other grants. That might be an avenue for communities to, those that don't have maybe the cost share can take that cost share over several years through the use of this fund to do mitigation actions for the communities.
Yeah, we can look at doing a write-up on what the STORM Act is.
So 2 years ago in the fiscal code, we did $5 million to PEMA for the Disaster Assistance Recovery Fund. And I was talking at the event in Yardley, was talking to Larry from PEMA, and just looking at the website, they paid out individuals from two flooding events so far, April 11th, 2024, September 9th, 2023. The April event was Allegheny, Armstrong, Beaver in Washington County. The September 9th of last year was Lackawanna, Luzerne, and Wyoming counties. So I'm pretty sure it was $5 million that the General Assembly appropriated. And it's for individuals when there's not a disaster. I'm pretty sure it's when there's not a federal disaster either.
Is it 4 or 5 million paid out? How much?
No,
how much it is?
very little has been paid out so far.
Even with those 2 claims satisfied?
Yeah, just pretty much most of it left. And there's, it's for making home repairs, pay for temporary housing, and replace certain personal items. So Pima, they have their guidance on their website for it. But it was just like a 2-line paragraph in the fiscal code 2 years ago. Very little details.
Why haven't we paid out more?
Well, there's guidelines to meet.
So people aren't just.
Yeah, just saying, I need this. I mean, there's got to be a true need on funding. So, they're going through, a process right now. The program was a DRAP, is what you're talking about.
The only other thing I would add, if you're done with that, is maybe a group insurance program or looking at it.
We could extend we could extend the task force to look, we could recommend extending this task force or another task force to look into programs like that too.
Yeah.
And how you would. Because I don't know right now what I would recommend in the group. I love the idea.
There are a lot of moving parts. So I get that. But it is an interesting idea.
Very interesting.
Yeah.
Director Padfield, I just can't.
What?
Director Padfield?
Oh, Director Padfield, I'm sorry, we missed you.
No, that's okay, Commissioner Humphreys. I just wanted to address, I heard the conversation regarding the Disaster Recovery Assistance Program. That is designed and it's relatively narrow scoped for a state individual assistance program, just so everybody's aware. And one of the things we have to do is when we constructed that program, one of the things that the federal government looks at is the state's ability to recover on its own, on whether they actually issue a federal major disaster declaration. So that program is kind of narrow scoped, and it's for right now individuals that would normally fall through the cracks, that would not qualify for an SBA low interest loan. There are incidents that occur that the criteria is it's an SBA declaration that we receive. It's not a federal declaration. So it's narrow scope, but we're taking a look at that program as we roll it out. And we use it to take a look at, the cost caps that we have on there, and also do we want to make any changes to that program? So it's in its infancy. We've actually rolled it out 3 times in a pilot, and now we have an SBA declaration in the Southwest for some of the weather that came through a couple of weeks ago. So we're working on the DRAP program for the Southwest as well. So we should have some good information on that, but that's designed not just for floods, but for anything else from a individual assistance perspective that would meet the SBA criteria.
More thoughts on the group insurance program? Because I do think it's really interesting. I don't know where I would, I think we could fund an RFP or something for groups to come up with different options potentially.
Yeah, I'm just hearing about this for the first time today.
Yeah.
So I'd like to give it more thought.
Yeah.
But I don't agree. I think we should at least think more about it because, there are potential, there are issues that we have to work through, obviously. But
And it sounds like something that, even local communities could engage and they wouldn't know how right now unless they Google Carolyn.
Right.
Yeah. But just getting more resources available to people
and providing maybe an enabling legislation to enable them to
set something up.
Yeah.
Yeah.
Yeah. And I'm not sure local governing bodies would be the best aggregators, but maybe legislation that would enable them to set something up, a separate entity or something. I don't know.
Any other thoughts on ideas maybe that we missed, should include, should not include? I think very clearly we need to come back in June to meet. We'll work on this in the interim, beef up the areas that we've talked about today, try to get something back out. Some areas I think will be more clarification in the recommendation. Others I think will be more information. I think we need more information on how the uniform construction code process works in order to consider whether we would make that recommendation.
My only other point would be, depending upon how we approach number 8, going back to 5A, and also thinking about increasing that credit perhaps a bit to help with the affordability of insurance.
Would you want to see, Dr. Kuski had mentioned, essentially a subsidy program for low-income means tested? Is that something that you would want to see in the recommendations?
I would definitely be in favor of this, yes. But I would also like, I mean, what I think is written here is good, but to me, it reads almost like primarily covering the cost of the upgrade, right? To help, again, mitigate risk and reduce risk, which is important. But it doesn't necessarily get to the cost of the policy, which is where I don't think the incentive, a little bit of a tax break on that.
That's one of the areas even that we were thinking about earlier today was, could you use the state fund to be the premium assistance program versus the back end, maybe do it somewhere else.
Or it could be have 2 parts to it.
Yeah.
Or it could fund the high deductibles too.
Right.
Any other thoughts from the group? I can't see it. Are there any hands up from anyone on?
I don't see any.
Here's an opportunity for anyone on the phone, members of the group or their delegates, to raise your hand. Okay, hearing none, I think we've got some more work that we'll go back and do, and hopefully get an updated version of this and additional kind of materials to everyone. And I think we have a tentative date already for our next meeting, right? In early June.
It's the first full week.
Yeah, I thought it was the first, like 5, 6, somewhere in there. So we'll get that sunshined with the intent to come back and just kind of have a remaining time focused just on the report. No outside speakers for that one. We'll just kind of focus on our work product so we can narrow it down and make sure we meet our July 1 deadline. So with that, I think we will give everyone an hour back. So thank you all. Really appreciate it.
Thank you.